Welcome, everybody, to the monthly update of the Simplify Managed Futures Strategy ETF. Ticker is CTA. This is the What's Trending in CTA podcast, and we're updating as of the month of June or quarter end for second quarter. So I'm going to dive right in, talk about some of the behavior of the fund over the quarter, some of the positioning, a big part of which was driven by some of the activity with the Strait of Hormuz closure and the positioning within energy and more specifically oil. So thank you guys for tuning in. And as always, I always like to say, we're here to answer any questions. Please reach out if you'd like more information or any additional details on anything we've shared on today's podcast. So I will share my screen and we will jump ahead. As of the end of second quarter, we are looking at annualized return of CTA of about 6.75%, still producing attractive alpha relative to the SocGen CTA benchmark, which has been about 3.5%. So about 3% annualized excess return over that benchmark. And then, of course, as always, I mentioned the kind of core objective of managed futures and trend following within the broader portfolio is really that diversification, that ballast alongside the key driver of portfolio risk, which is equity risk. And you'll see that we continue to deliver a very low and even negative correlation to the S&P 500, about negative 0.2 correlation since inception, and even lower correlation to core bonds. And I say that because we see a lot of our investors sourcing their allocation for managed futures from fixed income. And so you're really providing that ballast or that offset as we've seen stock bond correlations rise meaningfully really since 2022. So strong diversifier really across traditional assets. And then you'll see relative to broad commodity benchmarks, some good diversification power as well, about a 0.2 correlation to the Bloomberg Commodity Index. We've seen that correlation, at least on a year-to-date basis, rise, and we'll talk a little bit about what's driven that, of course, with some of the oil positioning, but still delivering on that core objective. For those of you that may be new to CTA or to this podcast, just a quick overview of the markets that we trade in. CTA is quite unique relative to the other trend following peers in the industry in the sense that we are just trading in interest rate and commodity markets. We've intentionally excluded equity and FX. And you'll see here we have exposure across US, Canada, and developed Europe and the UK. So let's dive right into performance because I know that's where we're all here today. Excuse me. So you'll see on the right-hand side of this slide the quarter-to-date performance. So this is going to be from 3/31 through 6/30. The white line is CTA. The orange line is the industry benchmark for trend following, which is, again, that SocGen CTA index. And you'll see we had a good first half to the quarter. Some of the long positions in oil drove the outsized returns relative to the benchmark and some of our peers. And then ultimately that tailwind became a headwind in mid-May, as we know. That's when the peace talks started to surface, and we started to see the reversal in the oil trade that had taken place over the course of really, late March all through April. And then into, as you see here, mid-May. And so that really had the sell-off in oil had a high correlation with the performance of CTA as we held a pretty concentrated position. And let me pause here for a moment as well to reflect on, as I mentioned, we are differentiated from the industry in the sense that we do not have equity and FX, but we are also a really strong complement to many of the other strategies in the market due to our more more concentrated nature. So really alpha seeking by design, and seeking to really lean into those parts of the market where there are strong price trends. And so we did experience heightened volatility in the quarter, which is experienced here as well, both on the upside as well as on the downside, which I would say is in line with some of our behavior historically. Again, really our intention is to provide alpha or make hay while the sun is shining, as we like to say. But we understand too that will have its short-term setbacks, which is what we saw here at the end of June. You'll see on the left-hand side of the slide, our trailing 1-year and 3-year performance within Morningstar category. So still maintaining that top quartile return on a trailing 3 year as of the end of June. So we're still focused on providing that long-term differentiated return stream to not only traditional assets being stocks and bonds within your portfolio, but also, as mentioned, a nice complement to some of the other managed futures solutions on the market, given our differentiated process in markets in which we trade. I'll jump into some of the specifics on performance. You'll see here again, this is as of the end of June 2026. Starting with that month-to-date column on the far left, you'll see that commodities were the key headwind to performance over this period. Interest rate contribution to returns were fairly neutral. And then you'll see on that month-to-date column in about the middle of the slide, the key detractor being Brent crude. So we talked about this on the last month's update as well. Highly encourage anybody that's following along to go back and take a look at the May update as well as the April. Charlie and I gave a little bit more context as to broadly commodity markets, what was going on in crude oil that helps explain some of this outsized positioning. And then as I just shared on the last slide, that drawdown in the back half of May and through June is where Brent became kind of a key detractor for the portfolio. Cocoa has also experienced a little bit of a detractor for total portfolio performance as well. But really, Brent here is kind of the key story for both the month-to-date and quarter-to-date performance period. You'll see that cattle feeder and live cattle are in the contribution component for month-to-date. And so just wanted to highlight that. That's been a position that we've held off and on over the last year, really. There's been some interesting trends taking place within the cattle market, just given the lack of supply here in the US, and then ultimately some of the headwinds to price, as we've talked about imports from other countries. But that has been a positive contributor, and we've maintained a long position within the cattle market for most of the last quarter. If we move to more to the quarter to date and year to date period, the one thing I do want to call out again, the drawdown in CTA in the back half of May and into June, driven by the outsized position to Brent, that essentially pulled performance for the year to date period down as well. And so that's why you see that as a key detractor in the quarter to date and year to date period. With that, also, I want to highlight kind of where we stand today. You'll see the black line is the commodity notional exposure to commodities within the fund on a rolling basis over the last 12 months. The gold line is interest rates. I would say focusing on the right-hand side of this slide, the key takeaway is the fund really sought to start de-risking into April and then into May. So you'll kind of see interest rate exposure peaked really at the end of first quarter, has been kind of scaling back since. Commodity exposure peaked kind of in mid-April, and again, starting to think about the drawdown in oil prices. The fund did de-escalate some of its position in oil towards the end of the second quarter. So in the final kind of week of June, the position in Brent was reduced by about half. I would say, as always, this is a very kind of fluid situation in regards to positioning. CTA has the ability to rebalance on a daily basis. And so the numbers that you're seeing here, the information that I'm sharing verbally as well, is absolutely in flux. It is a dynamic strategy. So we talked a little bit about kind of reducing some of the volatility of the fund as well. We really peaked from a vol perspective at the fund level in kind of mid-second quarter. Volatility as of the end of this quarter and currently is much more in line with peers. And again, I think this is a great opportunity to just reiterate the investment thesis or process behind CTA is the ability and desire to lean into the markets when there are strong positive price trends. And then also on the flip side, we are not beholden to taking on risk or putting on exposure for the sake of doing so. And so that's why you see a much more dynamic volatility profile of this fund as well. And that's witnessed really here with some of the scaling back of exposure and the reduction in volatility as we started the third quarter. All these slides also, just so everybody's aware, are approved. So if you guys would like to have some of these to dig through further, we can always share these. I really appreciate this chart because I think it just shows the dynamism of the exposure that I was just speaking to. And this is sorted for both the commodity exposure on the left, the interest rate exposure on the right. by the quarter to date column from largest notional exposure to largest short notional exposure. And so you'll see crude oil and cattle, which are the two markets I just spoke about in more detail. Those were the two dominant long positions on a quarter to date basis. The short positions from a commodity perspective have been somewhat limited. We've had a lot of strong price trends within commodities broadly. Natural gas has been a kind of consistent short position, as well as cocoa. And I mentioned that that short position in cocoa was actually a small headwind for performance as well. And then you'll see on the interest rate positioning, kind of mixed across the board. There's been a lot of movement, which I think we're all aware of, a lot of volatility within rate markets over the last few months as a lot of central banks are starting to even hike rates or digest this what might be transitory or maybe even sticky inflationary data. And so there's been a lot of movement from both a long and a short position within the interest rate positioning within CTA. So although we're speaking a lot about commodities this month and really over the last quarter, the positioning within rates has been quite dynamic and quite flexible. So we've seen some shifts really from quite long to quite short and back to neutral as well. Just from a performance perspective, that hasn't been as big of a story. And then last thing I'll share for today's update is the commodity exposure as of the end of June. You'll see on the far left here, the black bar is as of June 30th, the gray bar is as of May 31st, and then the gold is as of April 30th. And so you'll see from the farthest left, Brent crude position was reduced meaningfully as of the end of this quarter. As of the time of recording this, really in the first week of July, we have seen an increase slightly into Brent with some of those peace negotiations kind of coming off the table and Brent prices starting to rise back up again. So keep an eye on that. And as mentioned, we are here to answer any questions or provide any more insight that you guys may need on your end. And like I mentioned, the interest rate positioning has been in flux the last couple months, and I would say is less of a narrative at this point for performance relative to commodities. So with that being said, I will close out. I'm going to stop sharing my screen. Just want to finish by saying thank you everyone to continued investors. We're here to support you. We appreciate your support. Please reach out if we can offer any additional information, and we look forward to sharing more at next month's update.